Hey, good afternoon, everybody. Want to take this opportunity to welcome all of you to today's event, Preparing for Shocking Inflationary Data. You got John Hopkins here, Tom Bowley, going to jump in just a minute. If you are new to Earnings Beats, we welcome you with open arms. And of course, we want to also welcome all of our wonderful members. Many have been with us for many years, some since the very beginning of our inception back in 2004. Pretty exciting. This event's going to be recorded, so you don't have to worry if for some reason you've got to leave. That's no problem at all. We will make sure everybody gets a copy of the recording once it's done and properly edited. This is a new event, very timely with some key reports coming up. Tom thought it would be a great idea to get everybody in the room here and share some of his thoughts. A lot of our webinars are around earnings. And as a matter of fact, we've got another webinar coming up next week, I believe it is. Is it next week already? Yeah, our Max Payne webinar, where we're going to see which companies might be prepped for. Actually, I think it might be in 2 weeks. Anyways, Tom will talk about it. But this is when we talk about which stocks might make big moves during options expiration week. Always very exciting. We still have a lot of exciting educational information. You become a member, you get access to all of our webinars in the webinar video library. Very, very extensive along with everything else we offer. Anyways, why don't we just get rolling? So I'm going to welcome Tom Bowley here. Hello, Tom.
Hey, John. Can you hear me?
I can hear you, yeah.
All right, I'm running in. I got some issues with my computer right now, so we may have to delay about 10 minutes. I may have to reboot.
All right, so then what I think what we'll do then is, if that's the case, let's take a break for a couple minutes. I'll come back in a few minutes, talk about a few things, and then we'll get this thing going in about 10 minutes, right?
All right, sounds good. Thank you.
Yeah, sure. Okay, so Tom's having a little bit of a technical problem, so we're going to have a little bit of a delay. I do want to mention, I guess, while I have the opportunity, I'll mention a couple things. Tom's going to actually display it for you in a few minutes. We're having our spring annual sale. We do that twice a year, spring and fall. So if you like what you hear tonight, feel free to take advantage of a deal that's going to get you 14 months instead of the standard 12. You save a lot of money. The other thing is, I know we've got a number of people in here tonight who get our Earnings Beats Digest. That's our free newsletter. This week, we decided to share with everybody on Monday, Wednesday, and Friday, that's the days it comes out, Tom's daily market report, which is really extensive. And we just wanted to give you a little feel for what our members see on a daily basis. The daily market report is very extensive. It's broad in the market coverage, talks about sectors, talks about individual stocks, strategies, our strong earnings chart list, which is one of our hallmarks. In order to get on the strong earnings chart list, you have to beat earnings expectations, top and bottom line. And give me just a second here. Just want to look at something real quick. Okay, let's see here. Hold on a minute. Right now, just to give you, some of you who are new, just a sense of our chart list, we have right now, as of May 29th, 646 companies that have beaten Wall Street consensus estimates. So both revenues and earnings. They're liquid. They've got solid technical charts. And we update this every 2 or 3 weeks. make sure you're presented with strong trading candidates. Now, what's really great about this is if you're a Stock Charts member, then you can extra or higher member, you can take our chart lists and just add them to your Stock Charts account so you can scan based on any criteria that you think is important to you. Maybe you're really into moving averages, maybe you're into MACD, maybe you're into volume, whatever it is, you can dictate and spread scooter scores. You can scan for trading candidates that might suit your particular style. If you just happen to be stopping in, by the way, Tom was having a bit of a technical problem. He'll be back in just a couple minutes to get started on the main program. I'm just talking about a couple of things because there's a lot of new people in here tonight. So you got that strong earnings chart list, hallmark of our chart lists. Then we have our accumulation distribution chart list. Right now, there's 478 companies on this list. And basically, you have to have a scooter score of 80 or greater at the time of selection. That's a Stock Charts scooter score. And you have to have a strong accumulation distribution line. And those strong AD lines can be very powerful in terms of identifying stocks that could be primed, for a nice move higher. And then, of course, I got to tell you something. Our timing could not have been better. Towards the end of last year, we started our short squeeze chart list. Right now, it's got 42 companies on it. And that chart list, when we first put it out, the time was unbelievable. One of the stocks there towards the end of the year was GameStop, when the stock was trading for, I don't know, $10, $8, $7, $8, $9, and before it totally took off. And that particular list is made available to our members, and it's in descending order from the most shorted stock down to the one that's least shorted, but still you have to have a short float of at least 20%. So that is a powerful list that our members get access to. We update that. Generally, that's updated, I think, on a 3 or 4 week basis. Depends upon when new short data comes out. Got another chart list called our Strong Futures Earnings Chart List. That's got 207 companies updated back on May 29th that belong to strong industry groups, have scooter scores of greater than 80, and they're not on our strong earnings chart list. So they're really companies that are currently favored by Wall Street, which suggests we'll probably see better than expected quarterly revenues and earnings as we approach their earnings dates. Just a couple more real quick here. We have our raise guidance chart list that was updated June 1st. These are companies who raised either revenue or earnings guidance. They meet liquidity requirements and show bullish technical tendencies as well. So that's a tremendous tool for our members. And again, anybody who is a member of Earnings Beats gets access to that list as well. And let me just wrap this up quick because I know Tom's back. We of course have our portfolio chart lists. There's 40 stocks. 10 of each of them are model, aggressive income, and strong AD portfolio. And then when we do webinars, sometimes we have customized and special chart lists as well. So the chart lists are just a tremendously powerful tool. And if you are a Stock Charts extra level member higher, you can take all these charts, put them in your Stock Charts account, and go at it in any fashion, scan any fashion that you want. And we even have ourselves. We have a scanning strategy section, for people who maybe are looking for ideas on how to look for trading candidates. Anyways, that was fortunate. We could just have a few minutes to go over some of this stuff, and that's why we want you to, if you're an Earnings Beats Digest member right now, you're getting that daily market report for the rest of this week. That'll just give you a very, general idea of what Tom's covering on a daily basis. If you like what you see, combine that with the great spring special we have, and you'll save a lot of money. Okay, Tom, I'm glad I actually had a few minutes to talk to people about a few things we offer. And you're back on the scene here?
I'm here.
He's there.
Yeah,
I was going to keep talking.
I think I've just got like, I don't know if everybody or others have this problem, but I really struggle with Safari. I don't know what it is, but there's so many conflicts with Safari. I really should just be using Google Chrome more often because I don't seem to have some of the same issues.
Yeah.
But everything froze up. Everything froze up for me with Safari. I couldn't get into anything.
Oh boy.
Yeah.
Well, so Safari, no goodie.
Yeah.
Okay. All right. So anyways, I just sort of talked about our chart lists and the fact that we're giving all of the Earnings Digest folks a complimentary look at the daily market report, which is really extensive. I talked very briefly about the spring special, which maybe you'll talk about a little bit more. I'm going to go ahead and step aside and let you take it away.
All right, sounds good. Appreciate it. Yeah, as far as the DMR, I thought this would be a good week. First of all, we are running our spring special, and we want to make sure that we extend our thanks to everybody who in our community. Obviously, our paid members are the lifeblood of our business. But we also realize that there are a lot of folks out there that still trying to get to know us, looking to see maybe if we have things that can help in their investing or trading activities and so forth. And so I think the EB Digest is a great way for us to kind of connect with a much bigger audience to provide some guidance, some education, some potential trade setups and that sort of thing. And I think that our research platform is really second to none. And I think our daily market report is really solid guidance that we provide every day that the market's open. And so I thought that would be a great way to say thanks to everybody for supporting us, whether through the Earnings Beats Digest or through actual membership. Obviously, the latter is very helpful for us to actually manage our business and run our business. But anyhow, I don't want to spend too much time on that. I really want to get into some of the inflationary things that are going on because we do have big reports coming out this Thursday. We've got the May CPI report that'll be released Thursday morning before the market opens. And then the May PPI will be out next Tuesday, June 15th. And then, of course, we've got the Fed meeting Tuesday and Wednesday of next week. So there's not a whole lot else going on, really. So this is, the market's got inflation to focus on. And so I think here over the next week to 10 days, we're probably going to get some pretty good clues. I think we're already getting some, and I'm excited to go over some of my analysis. For those of you that maybe aren't familiar with us at Earnings Beats and with me, and more specifically, my background, I'm a CPA. I was in public accounting for 20 years. And so I've just always had this desire to analyze. I like to analyze everything. So anything I can put on a spreadsheet and take a look at and try to figure out what's going on, I do it. And I think that's why I was so attracted to the work that John Murphy did, because it's not the stock market went up or the stock market went down. It's what happened underneath the scenes and, or under the surface of the market. And that's what really drives the stock market. In my experience and all the research, everything I've done, it's not always what you see in terms of, the S&P 500 went up or the Dow set a new high. We were setting new highs in October of 2007, and that did absolutely nothing for us. And if you look underneath the surface, there were a lot of warning signs back in 2007 in October. Everybody talks about the 2008 financial crisis. financials were going down on a relative basis at the beginning of 2007, 9 months before the market topped. So if you have the ability to look beyond just the basic numbers and what people are telling you, um, in the financial news headlines, if you can look a little bit deeper, I think you're going to get a much better understanding of what's taking place in the stock market. That's really what I try to do, and I think what we convey pretty well, I think, at earnings beats. And maybe some of you have followed me over at Stock Charts for a while, or I know we've got some members that go back 17 years to when we first started the business in 2004. And of course, lots evolved, not just in our business, but just in the market in general. The market's always changing. If you think you know everything in the market, you probably ought to hit the reset button, because it continues to change. So you might know a lot based on everything that had taken place a year ago or 3 years ago or 10 years ago, but that really gives you no advantage going forward other than just knowing the history of the market, because things continually change. So the whole idea with this webinar, and we just kind of came up with it here in the last week or so, maybe the last couple of weeks, and it was because of the reaction we saw in May, where right before the PPI and the CPI came out, I think they came out around the May 12th and 13th, we had a big drop in the market. The S&P 500 fell about 180 points, 190 points in 3 days, right before that data came out, and then the day of the CPI coming out. And then when the PPI came out the next day, the market gapped up and started moving back higher. But as we did back a year ago during the pandemic, we did some pretty detailed analysis to take a look at what is really going on underneath the surface of the market, because to me, that's much more important than going to Bloomberg or going wherever and just reading an article on what the S&P 500 did. I mean, that's pretty easy. Just because the market goes down doesn't mean it's bearish, or just because it's going up doesn't mean it's bullish. You've got to be able to read those tea leaves, and be able to look under the hood of the market and really get a better feel for what's going on. So I'm going to go through some of the areas that I think are worth noting, how they've been trading here over the past month, really, compared to what we've seen historically. Now, we haven't really had inflation problems since the late 1970s into the early 80s. Inflation's been coming down, but we have had a couple of bouts. And so one in particular that I want to look at, and I'll go over with everyone, is a period from the end of 2003 for almost 3 years. It was November of 2003 to September of 2006, where we had a similar run in inflation. Now, we've done it very quickly this time, and there's some reasons for that. The pandemic last year took PPI and CPI much lower than normal because of the pandemic. And now we've got the demand kicking in and supply shortages everywhere, supply chain disruptions everywhere. And that's sending, in the short term, many of these readings, inflation readings, much higher than what we would expect. And it's that combination year over year, which has completely changed the inflation picture in the last 3 months, really last 2 months. It'll be 3 months when the reports come out this month. So that's kind of what we want to go over, but I'm going to start. Let me go ahead and pull up my screen here. So I'm going to start with a chart that I always start out with in most of these types of webinars. Members, I'm sure, will recognize it pretty quickly. And this is what I just consider the big picture. I mean, it doesn't get much bigger than looking back over 100 years on the S&P 500. I think that's pretty long, gives you kind of a wide range of what's going on. I mean, I don't know about you, but I wasn't around to see anything back before the 1920s. I wasn't around to see anything before the 1960s. But I do like to study history, and I do believe history continues to repeat itself. And so from a big picture standpoint, I think it's really important to understand some of the things that take place. And again, I've gone through this before. I don't want to spend a lot of time on it, but secular bear markets tend to last about 12, 13 years, and secular bull markets tend to last about 2 decades. And secular just means long-term. So yeah, last year, that was a cyclical bear market when the pandemic hit, and we went down 35% in a month. That's a cyclical bear market, a short-term bear market. That's completely different than the market going nowhere for 12 or 13 years. like we saw from 2000 to 2013, or, from 1969 to 1981. We went nowhere. We had these two big drops, kind of rebounded, but we weren't able to break out to an all-time high for a dozen years. Same thing had transpired back 2000 to 2012, 13. And similar, we had these two tops in 1937 and 1946, that when we finally broke out in 1951 above that double top, you can see the 20 years it took place moving higher. So this has been the long-term history. So I believe we're still in the early stages of a secular bull market. That doesn't mean we're not going to sell off from time to time. We saw that with the trade war. We saw it with the pandemic. I mean, it does still happen from time to time. But when you're in a secular bull market, the market recovers much quicker. So when I start thinking about, I look at some of the headlines last month talking about inflation and all, I still go back to this big picture. And, right in the middle of the pandemic last year, I think it was on March 13th in the Chart Watchers newsletter, I said we were in a secular bull market, even though we were in the midst of this huge collapse. And a lot of folks, I got some emails at the time saying, you're just a perma bull. And well, I mean, I'm not a perma bull, but I do believe that I know the market goes up a lot more than it goes down. And so unless I'm seeing some other signs, I'm not just going to assume that we're just going to keep going down all the time. And it's actually the opposite. We tend to go up almost all the time. And so you really want to pick your spots and identify these secular bear markets. That's a big difference than these secular bull markets. You can have a 1987 crash. You can have a 2020 pandemic. You can have those types of moves to the downside, but you can still be in a long-term secular bull market. And that's what I think we're in right now. So when I look at inflation data coming out and the market pulling back, I'm thinking opportunities. I am not thinking secular bear market. I'm not thinking protect capital and hedge with gold and those types of things. I'm thinking this is creating some opportunities. Anyone back in March of last year, looking back now, it's easy to say, hey, that was a great buying opportunity. But it's not as easy to say it right when you're in the middle of it. And I think, again, it comes down to looking under the surface of the market and not just paying attention to headlines. Headlines they're going to try to scare you all the time. That's clickbait. Everybody wants you to read their article. And some of them, I mean, I'm not saying all of it's intentional. I think some of it's intentional, but I think a lot of times it's just you get news and, you think about the 10 o'clock or 11 o'clock news at night. What are the top stories? It's the car crash. It's the flood that's, washing houses away. It's not the Boy Scouts doing good things. It's always negative stuff. That's what drives folks to want to click and read and so forth. And so you got to keep that in mind when you're looking and reviewing financial media. And I've said this before, but when I write articles at Stock Charts, I'll get triple the viewership. Like when I wrote back in September that the market was topping, that I saw a lot of warning signs. That was one of the most heavily read articles I ever wrote. And it's, again, they gravitate toward bad news. They want to see the train wreck. So just be careful you don't fall into that. That's just my first point here. So this is just kind of going through the S&P 500 and maybe a little bit of history with inflation and so forth. So let me pull up the next chart here that I wanted to go over with you. So this is the S&P 500 monthly chart here on the top. And so again, I'm showing you, this is the 1970s. This is the 2000 to 2012. Just highlighted those secular bear markets. But I wanted to show you the core CPI down here below. So core CPI at Stock Charts, you can get this by pulling up the ticker symbol $, CCPI. You can see it right here in this left corner. $, CCPI. That'll give you the data. Now you want to use a monthly chart because the data only comes out once a month. So if you pull up a daily chart, it's going to be hard to read because you're not getting changes every day in the in the CPI, core CPI, or any of the inflation data. Now I also have on this same thing an overlay of the rate of change so that we can see what the year-over-year rate is of the core CPI. So I have the rate of change, and I've down here at the bottom I'll show you, I've got 12 as the parameter. So you just set it up with an indicator rate of change, put in 12, as long as your chart's monthly, that'll give you the 12-month year over year inflation rate. And so that's here. Don't confuse it with this rate of change down here at the bottom. This is the S&P 500 and how it's performed over 12-month periods, year over year. So during the secular bear markets, you can see that the big drops in the S&P 500 resulted in 40% declines during this secular bear market in the 70s. And then again, in the financial crisis back in 2008, during that secular bear market, we went down 40%. Look at the pandemic. The pandemic barely went negative. 1987 right here, we went a little bit negative, but we quickly rebounded off of that. We didn't get anywhere close to the 40%. So it's just different when you're in different market environments and different cycles within the stock market. Now, on this move up in inflation, here is where we had the big rise. We went from, now this is a, if you look over here on the left side, this gives you the inflation rate. So we went from 1% in 1966 to 13% in 1980. That's a pretty significant move in inflation. Of course, that was one of the primary reasons we had the secular bear market back in the 1970s. It was that, and of course, it was interest rates jumping. And if you don't have enough growth and you've got interest rates soaring, I mean, that's going to, it's going to have obviously a negative, very negative impact on valuations, because valuations are going to be based on two things: your growth rate going forward, and then you're going to take those profits in the future, and then you're going to discount them back. The problem is during an inflationary period, those profits are being eaten away by inflation. So you got all kinds of negative things going on and went on back in the 1970s. Now, currently, I mean, anybody who says we got an inflation problem, I want you to take a look at what we have right now versus what we had. Now, this occurred over, granted, 15 years. And, some might be saying, well, this is just getting started. Well, if it is, we're going to obviously have a lot of data. We'll have a lot of information that will be provided over time. I don't believe that that is the case. And I'll show you another chart in just a minute why I don't believe it's the case. I don't think we're going to see inflation at all outside of maybe the next few months. I think we're going to top, and then I think our inflation rate is going to start to come down. And that is pretty consistent with what the Fed believes. Now, you might not be a Fed fan. Sometimes I'm not a Fed fan. But one thing I will say about the Fed is that you got a group of some pretty smart individuals on that, in the Federal Reserve. And when you start looking at, someone like Jerome Powell, or whether it's Ben Bernanke or Janet Yellen, I mean, these are really smart people meeting with other really smart people, trying to direct interest rates, our interest rate policy, and trying to stabilize prices. That's their two primary goals, So I try not to outthink them. They're pretty smart. And we haven't had an inflation problem since the early 1980s. And yet I can probably tell you multiple times, many times, where I've heard, oh, inflation's becoming a problem. Inflation's starting to tick up. We're going to go into hyperinflation. I mean, I've heard this for the last 12 years. The stock market keeps going up and interest rates are low and inflation is benign. So, I mean, you can follow all of these stories. There's some who just believe we're going to have inflation. They don't care what the inflation rate is. They're going to continually promote inflation. And eventually they're going to be right. And then they're going to say they were genius. When in fact, they don't point out all the times that they've been signaling or, these false alarms. So I would just be careful rushing into that judgment that inflation is going to be a problem. I think we are going through a bubble in our supply chain right now. I think demand has certainly picked up coming out of the pandemic, and there are reasons why inflation is jumping right now. But I'd be careful to jump on that bandwagon that this is a long-term problem. I don't see that at all at this point. So anyway, I just wanted to kind of point out where we were on inflation versus where we are now. And let's move on to the next chart. So on this chart, actually, I thought I had one other chart that I wanted. yeah, let's go. I'm going to skip ahead to this 2003 to 2006 period. Because if you go back and look from 2003, I'm going to go back to this other chart one more time. If you look back to 2003 to 2006, right in here, that was really this century. That was probably the most inflation, the biggest problem that we've had with inflation over the last 21 years, this decade, or excuse me, this century. That's been it. So from 2003 to 2006. Now, so with that, let me go back to this other chart. All right, so this is a chart from 2003. It's a weekly chart all the way over to the end of 2007. So right here is when we started to see the uptick in inflation. And it went all the way until where these arrows end, right over here, September 2006. Now, the S&P 500 kept going higher. You know, this wasn't, I mean, we were in a cyclical bull market back in that secular bear market at the time. So the S&P kept going higher, but it was being led mostly by energy and materials. You can see here, this is technology. See technology going down on a relative basis. And then you had consumer discretionary going down on a relative basis. I mean, these were, these were some of the higher growth areas of the market. And that's the problem. When inflation really begins to rear its ugly head, you've got to be careful if you're in growth stocks. And when we look back to what just happened in May, I'm going to pull that chart up next. When you look at what happened here's May 10th to May 13th. This was so the 12th is when we got the CPI came out, the morning of the 12th. You can see the huge selling that took place. And then May 13th was the PPI. And we actually put a bottom in, went back down, almost reached that low again. And then we've been trading up ever since. So yeah, we had an initial move to the downside, but the stock market doesn't really seem to be overly upset about inflation right now. And it's not just the fact that the S&P went up, because we did that, like I was showing, back in 2003 to 2006. Even though we had an inflation move to the upside, the S&P kept going higher. So it's not just about what's happening to the S&P. What I think is important is to look at what's going on underneath the surface. And here you've got technology relative to the S&P 500. When we went down May 10th, 11th, and 12th, you can see technology went down and took a hit, but we bottomed. And now here we are just a few days from the next big inflation report. And look at where we are on technology relative to where we were a month ago. Technology's been performing well. I'll show you some numbers on my spreadsheet in a couple minutes that I think will highlight what's been taking place in technology. Now, consumer discretionary continues to be under pressure. No doubt this is a group that is struggling, and it tends to perform poorly during higher inflationary periods. So these are two that I would really continue to watch. They're diverging: technology rebounding, consumer discretionary going lower. Communication services, though, this is another area of growth that I would think would be struggling with the potential of higher inflation. And yet, where are we? Setting a new high, a new relative high versus the S&P 500. And then we've got industrials and financials, which overall I think continue to move up. And look at what's happened here over the last 3 weeks with gold, the GLD relative to the S&P 500. Gold has been underperforming the S&P as we go into what should be another really high inflationary report. So my point here is professionals are not moving in to gold, which is a hedge against inflation. So if we go throughout this week and into next week, and we get through these inflation reports, and we get through another Fed meeting, and gold hasn't broken out against the S&P 500, that is a sign to me that the market is not at all concerned, or not nearly as concerned as some of the headlines might suggest, that inflation's a problem. So I think it's really important just to, again, continually look beneath the surface of what's going on. Now, I had one other chart. I'm trying to think where I put it. Well, I will just go back and show you here. This is gold versus the S&P 500 in 2003 and 2000 through 2006. So remember that inflation rate was really starting to pick up in 2006, and you can see that gold outperformed the S&P 500 toward the tail end of that. So that's one of the things that I would be looking for to confirm that the market is concerned about inflation. Look at what we're doing over here, gold versus the S&P 500. Inflation's been moving up. Inflation's a problem, right? Not based on the way gold's trading. I mean, gold relative to the S&P 500 is very close to its century low, certainly decade low. So again, let's watch the rotation in the market in addition to the headline news. Headlines will just scare you out of positions. Think back to the pandemic. I remember headlines talking about Great Depression 2.0 on the way. And yet what we were seeing when I started doing all my Excel spreadsheet work and actually looking at what was taking place in the market, the areas of the market that should have been getting hit the hardest by a pandemic were the groups that were leading back to the upside. Made no sense whatsoever. So, that's when we actually, during the lockdown, we started doing more of these types of sessions. If you recall, we did, I forget what we called them, but we were doing sessions on Fridays because people were home and locked down, and we started pointing out a lot of the facts that were taking place on the charts that weren't being talked about in the media, like the huge recovery in many of the growth stocks during the day. Even though you'd see the big gap downs, they would recover during the day, while other areas like airlines, cruise lines, and things like that would keep going lower, showing distribution. We had accumulation in a lot of other areas of the market, and that guided us throughout 2020. We stayed away from those groups that were being distributed, and we continued to concentrate in the ones being accumulated. It's kind of a similar thing what we're doing now. We've got these, and what I try to do is I look at key dates, just times in not in history, because we're only going back the last month, but just times, when we're getting inflationary data, and where are all of these sectors, where are all the industry groups before we make these moves down. So let me go back over here and show you, because this is kind of a little bit of a lead in to what I want to go over on my Excel spreadsheet. But no, it's not the one I wanted. Yeah, this one right here. So what I ended up doing is the S&P 500 took a big hit from here down to here in 3 days, 2 days, 48 hours, basically. And so what I wanted to do is see, okay, where were the sectors at this point, and where did they go to? What about all the industry groups? What about the major exchanges, the major indices, the NASDAQ, the S&P, the Dow, the small caps, mid caps? What did all these things do during these 2 days? And then from the lows to now, how have each of those groups rebounded? Because normally what you'll see, like back in, 2007, for instance, when financials started to go down, when the stock market went back up to a new high in October 2007, financials didn't go with it. It was an opportunity to get out of financials, and financials continued to go lower and lower throughout that period. So as I look now in the month of May and into early June, I'm looking at the same thing. If we're truly going into an inflationary period where, you don't want to be in growth areas, then the same areas that were leading to the downside during these 2 days, you should not be seeing huge rallies in those areas since then. If anything, more and more money should be rotating as they bounce a little bit. We should be seeing more money rotating out of those groups. So with that in mind, I'm going to switch over now, and I'm going to show you some Excel spreadsheets, some data. So let me switch this for you 1 second. All right, so the first thing I have for you here is the inflation data from back in November 2003 to September of 2006. So what I wanted to do is just go back, look at all the major indices, look at all of the sectors, look at the industry groups, and see how they all did during that period, just to get a sense of, okay, what performs well in an inflationary environment. I mean, I'd like to go back and look in the 1970s and early 1980s, but stock charts doesn't have everything broken down by the sectors. I mean, I don't know how to do that other than with the major indices. So it's just not very practical. But we didn't have all of the industry groups, as you'll see many of these industry groups down here at the bottom. They didn't come up when I tried to pull up 2003 data. So obviously they came out later, but there's still quite a bit of industry groups that we could go back and look at history. And what we saw during that inflationary period, this maybe shouldn't be too much of a shocker. The S&P 500 went up 26%. Steel went up 214%. So you can see, obviously, the price of steel. I mean, that kind of makes sense to me. When inflation is a problem, it's because many of the commodity prices are going up. Keep in mind, too, that during this period, the dollar was under a lot of pressure to the downside, which was helping to fuel energy and materials, which in turn was helping to fuel the inflation for a period of time, longer period of time. But anyway, you can see steel did very well. Energy, the next three top areas were all in energy. And then we had heavy construction. I found the sixth one, internet's kind of interesting as the number 6 group during an inflationary period, but it was also back when, the internet was really just kind of getting going. So maybe that was kind of a more specific to that. Railroads. And then we had non-ferrous metals, another material, then integrated oil and gas, another energy. But what you don't see here at the top are technology areas or consumer discretionary areas, because those high growth areas, their profits erode in an inflationary period. So even though the market was going up, and even though GDP was higher, and even though, companies' profits were going up, the valuations were going down in many of those areas. They're certainly not rising as much as the S&P 500, because inflation was eating away at those profits. And, when you get higher inflation, you're going to have interest rates that go up to combat higher inflation. So then you got higher interest rates, which are eating into valuations of growth companies. So that's what you have to be careful about if we get into an inflationary environment. Growth is going to get hit. Now, we've seen in 2021 growth stocks not performing well. And we could debate what's driving it. Personally, I think we went so far, so fast in 2020 that I just think many of the valuations of the companies, you needed the fundamentals to start catching up to the valuations. So valuations were coming down a little bit. Fundamentals, I mean, we kept seeing all this last quarter, earnings going up. Most every technology company was beating estimates, but technology stocks overall were coming down. They just gone up too far, too fast. I think that was the problem with technology. Now, you might argue that they've been coming down because inflation's picking up, and inflation is going to drive interest rates higher, and all of that's going to eat into the valuations of technology and consumer discretionary stocks. That's a legitimate argument. I don't think that's going to pan out. That's just my personal opinion. I think that it has much more to do with the huge, massive rally we saw in 2020 as opposed to inflationary concerns. I mean, when you look at the relative strength of technology versus where it was a year ago, it's still way above where it was a year ago. That wouldn't be the case if inflation was becoming a problem. Everybody be bailing out of technology. So I think there's accumulation that's taking place, and I'm starting to see some of these growth names beginning to perform pretty well again. And so I'm getting more and more encouraged by it. But I'm going to continue to watch, I think over the next 30 days, next week, even through these inflation reports, how does the market handle it? Because we're going to have higher inflation numbers come Thursday and Tuesday. I'm going to say it's as close to a guarantee as I can make. These numbers are going to show year over year increases and year over year inflation numbers that we have not seen this century. Is the market going to focus on that? Are we going to see a big sell-off as a result? If we do, what's going to sell off? Is it going to be technology? Is it going to be discretionary? Are we going to see those areas move to new lows? If we have big inflation and we start seeing gold outperform, we see real estate outperform, we see energy, materials, all of those things outperform while technology and consumer discretionary continue to get hit, then yes, that to me would be much more of a sign of inflation. And what's going on with interest rates. If inflation is a big problem, rates should really start moving up. I mean, rates are not going up at the rate that inflation is. Inflation has been soaring for the last 3 months. Interest rates going sideways last 3 months. So I'm just not buying into the inflation story. I can see the data, but the market is not supporting a problem with inflation right now, in my opinion. So this kind of gives you an idea. Look at the sectors back in 2003 to 2006. Energy, real estate, utilities, materials, industrials, financials, consumer staples, healthcare. Then we get into consumer discretionary and technology. Those were the two worst. That makes sense to me. In an inflationary period that lasts for a while, interest rates going up, that's generally going to result in that type of performance, that type of rotation. All right, now you get down to the bottom. I want you to notice of all the industry groups from 2003 to 2006, look at what was in the last spot, semiconductors. One of the highest growth areas. Makes sense to me. Automobiles, specialized consumer services, auto parts. These bottom four, 3 discretionary industry groups and 1 technology. That's, there were only 7 groups that lost more than 10%. And outside of this aluminum and materials, everything else was in the aggressive areas of the market. Aggressive areas of the market do not like inflation. All right. So now with all that in mind, let's take a look at what's happening here over the last 30 days. So over the last 30 days, you can see there's real estate on top. That's good. Look at the next 2. Technology. Since that May 12th bottom, technology has been the second best performing group. It's gained more than it lost during that big drop. Gained it all back plus some. That's pretty impressive. At least I think so. So I think, you got technology and you got communication services. 2 of the big 3 are in the top 3 in terms of performance since we had that shocking inflationary data come out last month. Certainly doesn't look to me like the stock market's worried about inflation. And then when I go down and I look at, okay, what was performing really bad? Many of the growth areas were really struggling back in the, that May 10th to May 12th drop. Look at, there are 104. This, by the way, is a rank. This column right here, column I. So this is the rank of how these industry groups performed during that May 10th to May 12th drop. Keep in mind, there are only 104 industry groups. So this one was 92nd. This one was 81st. This was 91st, 93rd, 86th, 79th. You can see a lot of these were growth areas: recreational services, renewable energy, semiconductors, gambling. These were all high octane growth areas. The only one up there that wasn't was coal, and coal didn't do badly. Only lost 1%. So the ones that were really performing poorly were those growth areas. And let's see, what else? Here's auto parts. Remember auto parts on that other list? I showed you had a really poor performance from 2003 to 2006. Well, here they are again, 94th out of 104, growth area, not doing well. But in the recovery, it's the 13th best industry group. We shouldn't be seeing this kind of reaction, positive reaction and growth, in my opinion. I would think that this last recovery would be a final attempt for professionals to be unloading these areas and moving into materials and energy and real estate, utilities, the defensive areas, healthcare. That's not what's happening. Recreational services. So here in since May 12th, the S&P 500 has gone up 4%. Recreational services is up 20%. Renewable energy, 20%. Semiconductors, 14%. Gambling, 12%. Money's rotating back into those groups, not out of them. Again, if I start seeing headlines that are saying inflation, 20-year high, hyperinflation's coming back, and I see semiconductors continuing to perform well, I'm not going to pay any attention to what I'm reading, not in the headlines and in the news articles. I'm going to pay attention to what I'm seeing on the charts. And if this continues, if we continue to see money rotate, watch that IWF IWD ratio. Today, IWF outperformed growth outperformed value today. Here we are 3 days from what should be a pretty ugly inflation report. And believe me, Wall Street knows this isn't going to catch Wall Street by surprise. Just like last month, they sold off ahead of the reports that came out. They knew. They got a lot of MBAs on Wall Street. Trust me, they know exactly what's coming out in terms of news. They're positioning themselves. So if we continue to see growth areas being bid up heading into an inflationary, big inflationary reports, that just tells me that this is transitory, just like the Fed's telling us. So I would be careful. Right now, I think this is a dangerous time in the market. And I've said this really for the last 3 to 6 months, because once we got the positive vaccine news out in November, I've said really that I don't question the market going higher, and I still don't question the market going higher. I believe the stock market's going so much higher than it is right now. I think we're probably in inning 3 or 4 in our secular bull market. And we just had a huge cyclical bear market. You don't normally get those every year. So I think we're probably going to be good for a while. We'll get a correction. We'll get a 5%, maybe even a 10% correction from time to time. That may come over the summer. That may come in July, August. I mean, I don't know. We'll see. September, historically a bad month. If we're going to have one, I think it's going to be over these next couple of months. So right now, it's not about, for me, whether the stock market goes higher long term. I think we're going higher. The question for me is the rotation. Energy, materials been leading. Energy, by the way, look at, or materials, I should say, by the way, look at the last month. Materials, which fell 4% during that drop. It actually went down with the S&P 500. And on the recovery, you would think, hey, we're heading into an inflationary environment. Wouldn't you want to load up in materials? Materials, 10th out of 11 sectors. The only one they're beating right now is healthcare. That doesn't look like a market that's preparing for an inflationary surge. So yeah, we're going to get the numbers come out. The headlines are going to be out there. Keep watching what's going on under the surface. I think this is the most important type of analysis to do. Just keep tracking, and we're going to keep doing this for our members. I mean, this is one of the things that we do when we talk about market guidance. It's not telling you that what the S&P 500 did. That's easy. It's telling you whether or not the market, its advance is sustainable or not. That's much more important than telling you whether or not it's going up or down. You can look for yourself and see if it's going up or down. So anyway, all of this, I think, is really critical in the evaluation of the market and the evaluation of this bull market, the secular bull market, and whether or not it's going to continue. Inflation is one of those things that could take it down, no doubt about it. But I need to see more than just headlines. I need to see money rotating. And as I've just pointed out here, I'm just not seeing it. You go down all the way to the bottom, and you got utilities down at the bottom. You've got 2 materials groups, non-ferrous metals and aluminum down near the bottom. Paper, containers and packaging. These are all areas that have been negative over the past 4 weeks while the S&P 500 has gone up 4%. money is rotating away from areas that should be benefiting from inflation. That should be telling us something. So anyhow, that's essentially what I wanted to go over. I do want to just kind of bring back up one more time. And then John, if we have any questions, I'll be happy to go through those, but I wanted to bring back up. I didn't talk about it earlier, so I do want to just mention, this is a great time. If you like what you hear tonight and you like what we do with our Earnings Beats Digest newsletter, and you like these daily market reports that we're going to give to everybody in our community for the next week, we're doing, part of that is we've got a spring special that goes through Tuesday of next week. And so if you go to our website, you can't miss it. And you click on it, it'll give you some of the details of what we're providing. It goes through Tuesday, June 15th. Normally, if you sign up for a free trial, a no cost trial, you actually get charged $7, and then we refund you the $7. And then you have 30 days to evaluate our service. If you don't cancel, you start getting charged $147 a month. 12 times 147 gets you close to $1,800 a year. Well, during the spring special, we're going to give you 2 bonus months. You're going to get a regular bonus month. We always do for webinars, and then also a spring special bonus month. So you got a total of 14 months, which normally at $147 would be $2,058. Until Tuesday, we're doing it for $997. That's 52% savings, which is more than half off of that $147 a month. And I don't know of anyone that has a more comprehensive service than what we have. And that's one of the things I get a lot from our members. They don't understand how we get out so much information. We've got the chart lists, as John was pointing out earlier. Those get updated weekly or bi-weekly, most of them. Then you've got the scanning strategies that are out there. We've got our portfolios that we announce every 90 days. Just a tremendous amount of market guidance through the DMR. Tons of education, lots of webinars. Our Max Payne webinar that comes out once a month. That alone is probably worth, our entire service cost, in my opinion. But anyway, I just want to make sure everyone's aware that we do have this running through June 15th. So this is a great time to evaluate our service to see if this is something that you might be interested in. And anybody who already is currently a member and wants to extend, there will not be a better time to extend than right now. This will be the best deal you'll get the balance of the year. So, John, I don't know if we had some questions, but I'd be happy to go over
a couple of questions. I also want to mention, if you're a trial member, let's say you just sign up for a trial, we'll add your trial balance. So let's say you sign up a week ago, you've got 3.5 weeks left. That'll get added into the 14 months. So that gives you some extra time as well. Yes, a couple of comments and questions. You might want to just leave after this one. Fantastic spreadsheet. As usual, Tom knows what to evaluate. Genius.
All right, that ends the webinar.
Okay, the next one, I'm going to combine a couple of questions. Have to do with commodities. How do commodities do during inflationary periods? And what about lumber and copper prices? Temporary rallies?
Well, first of all, commodities should go up in an inflationary period. That's one of the things that drives inflation is higher commodity prices. And we're seeing that with oil. And energy stocks continue to do well. And I pointed out recently, and I think it was in one of our daily market reports, the bullish pattern on crude oil. I mean, I see crude oil going to $77 a barrel. So as long as that pattern is in play, that should drive energy prices higher and energy stocks higher. Now, where it comes to commodities, I'm of the belief that the dollar is going to rise. One thing you have to think about in 2003 to 2006, and the fact that commodity prices were going up during that whole period, is the dollar was going down during that period. And a falling dollar tends to boost commodity prices, tends to boost the relative strength of material stocks and energy stocks. So, and that's what we've had over the last several months. We've seen the dollar weaken. And while the dollar's weakened, materials, energy has done well. So right now, in this environment where we know inflation is going to be high, and everybody's been talking about inflation, and we know the dollar has been weak. I mean, it's down near a multi-year low right now. Materials commodities should be doing really well. And yet over the last month, materials I showed you was the 10th best performing sector out of 11. So why are materials not, those stocks, why are they not performing well right now? And I think it's two things. Number one, I believe it's because inflation is not going to be a problem. And I think that's what Wall Street is saying. And also, I believe the dollar is going to go higher. And that combination, if I'm right, materials are not going to do well on a relative basis. It doesn't mean they won't go higher. I think material stocks could go higher. In a secular bull market, pretty much everything goes up. But if the S&P goes up 100% over the next few years and materials goes up 30% over the next few years, being in materials is just a drag on your overall return. So I don't know, to answer your question, I mean, the short-term lumber prices, you know, we've seen so many areas skyrocket in terms of prices. And I know here personally, I was talking about having some work done at my house, and the guy that was going to do the work, his company, they couldn't get the materials for the job until next year. They told me, I can't get you the materials because there's such a backlog. There's so much demand. And yet companies during the pandemic didn't shut down operations, but they slowed down. So they didn't produce as much. And so now all of a sudden you've got this, you know, everything's trying to go through this, all this disruption in the supply chain, and demand is literally, from a building perspective, through the roof, no pun intended, but it's through the roof, and you've got supply that was cut off for a period of time. So that's in a nutshell what's been driving the other side of this inflation picture. Not to mention that a year ago, when the pandemic hit, we had all of these very low readings. We had 3 negative core CPI readings in a row. Never happened before. 3 in a row negative. And so those are going out of the equation. And then on the flip side, we've got this crazy demand versus supply chain disruption, which is sending the numbers up. That's why I don't think inflation is going to be a problem long term. I think we got to get through these next couple of months. And that's what the Fed's been saying, and I believe them. And maybe the Fed's wrong and maybe I'm wrong. But I think that what the market is doing, and some of those percentages that I was just showing you on that Excel spreadsheet, I think that's bearing me out. I think the market is telling us inflation is not a problem. And we're going to know a lot more in the next week or two.
A couple of people asking if tonight's spreadsheets will be available. Are you holding on to those yourself?
I don't have a problem sharing them. So we can make them available.
Okay. Should we sell tech and consumer discretionary now and wait a week or so before buying back?
What I will say this before, and you'll have to repeat that because I was getting ready to say something else, but I will give this spreadsheet to anybody who's a member at Earnings Beats, even a trial member. So if you're in the Earnings Beats community as a free digest newsletter, all I'm asking you is to try our service. If anybody who's a member, even a trial that never takes us up on the deal, I'll still, you can download this. So let's make it available. If Aaron's listening or Abby's listening,
Yep.
let's go ahead and I'll send you the spreadsheet. We can get it on our website, make it available to all members of Earnings Beats, even trial members. What was what was that next question?
Just, let's see. Couple here, and then we'll wrap it up. Montgomery said, I pull up SPX and gold GLD for the last 2 months. GLD is going up. This is not what Tom's chart showed. This is confusing. Can you shed some light on this?
Well, GLD is going up, but GLD relative to the S&P 500 is not going up. So first of all, let's get a weekly chart and go back a couple of years here, a few years. We'll go back 5 years on gold. So here gold is going up. There's no doubt gold is going up. I'm not trying to say gold is not going up, but let's get rid of RSI. We don't need that. So if you go over here and you take a look at gold relative to the S&P 500, here is where I'm talking about it's going down. So gold relative to the S&P, because remember, the last 5 years, the S&P 500 has been going straight up. I mean, we've had the pandemic and we had the trade war, but we keep going higher and higher on the S&P 500. So, I mean, gold, yeah, it's gone up, but if you're looking to try to outperform the S&P 500, this is where gold was relative to the S&P 5 years ago. And here's where it is now. So if you had the choice to get into gold or the spider and you chose gold 5 years ago, you're underperforming because this has been underperforming the S&P 500. Now, we did have one brief spurt, and here's the thing: whenever the VIX, the volatility index, starts going crazy, gold outperforms. When there's fear in the air, gold will outperform the S&P 500. This was the fourth quarter of 2018. Remember the trade war? Look at gold outperforming. Here's the pandemic. Look at gold outperforming. But once the volatility index starts to come back down, so too does gold relative to the S&P. So that's my point. It's not that it's not going higher. It definitely is going higher. But, you know, utilities are going higher, but I wouldn't invest in utilities during a secular bull market because they historically underperform during a secular bull market, just the same as gold. So hopefully that helps.
Let's wrap this up now with this last question. Should we sell tech and consumer discretionary now and wait a week or so before buying back?
That's a hard question. I mean, I wish I knew the answer to that one. You know, I said last week, you know, be really cautious. I've thought maybe technology was going to get hit this week just because that's what happened last month. So, of course, the market has its own ideas of what should happen. And as a result, we haven't, you know, saw technology, NASDAQ actually leading today, moving higher while the S&P was going lower, which again, I mean, Wall Street knows what's coming, and yet they're buying technology. What is that telling us? So should you buy now or a week or two? I mean, that's the part I think that's really hard about the market right now. That gets back to that whole rotation thing that I was talking about. I believe the stock market's going higher, but trying to pinpoint this week versus next month as to which group's going to be leading, I mean, that's the $1 million question. And I don't know what the right answer is other than to tell you this. If I was going to be in technology stocks, I'd be looking for stocks that are showing leadership, that are showing strength relative to their industry group, relative to their sector, relative to the S&P 500. Those are the ones that I would be considering at this point.
All right, let's go ahead and wrap it up right now. We will go ahead and make sure everybody gets a copy of the recording. Like Tom said, if you're an annual member or you sign up, you know, for that spring special, save a lot of money, you'll get the spreadsheets as well. And I think you'll find them, you know, very useful. I found this, Tom, to be a great webinar. I learned a lot listening to myself and appreciate the great job you did.
Thanks. I do want to clarify, because you said annual members. I did say I'd give the spreadsheet to anybody who's a trial member.
Oh, okay.
So, yeah, I just want to make sure that
I was upping the stakes.
Yeah. Well, hopefully everybody likes the service and will take us up on our spring special. But I'll make sure that the spreadsheet's available to anybody who is at least a trial member at Earnings Beat. You can download this. But this is something that I will revisit again, maybe in the next week or maybe 2 weeks, once we get through the next report, just like we did back during the pandemic. I think this is a spreadsheet that's worth revisiting again in another couple of weeks. So be on the lookout for that. All right, that's it. So hope everybody has a great evening. Appreciate you tuning in, taking time out of your day, and go over to Earnings Beats. Make sure you sign up for a trial or take advantage of that spring special. Have a great night, everybody.